Hi, this is Brad Levin, CEO of Legacy Wealth Partners. We've had some massive moves in the stock market over the past week, and I'm going to briefly shed some light on this and point out some important developments we're watching right now. Last week, all the major U.S. stock market indices dropped at least 5%, with the Dow Jones losing 1,360 points, stemming from growing fears of a possible trade war. Fortunately, over the weekend, those fears eased somewhat, and the market rebounded strongly yesterday, gaining back about half of last week's losses, only to lose a lot of those gains back once again today. Now, just 2 weeks before this, investors had dumped the largest amount of money ever into stocks in a single week. I highlighted this as a concerning sign because investor sentiment in the short term is often a very poor gauge of the market's future direction, as well as the fundamentals of the economy. And when investors behave irrationally, analysts and institutional investors will look for the market to respect or even follow historical patterns of behavior, and in many cases actually step in and move the market to cause those patterns to play out once again. With that in mind, let me show you some of the important recent moves the market has made and what it may suggest. After the market pulled back in late January into early February and reached a bottom on February 9th at 2,532, the S&P 500 managed to work its way back up towards the level of 2,800 twice, but sellers stepped in and pushed it back down from there. Last Thursday, the market dropped below the level that it had reached in between these two peaks at 2647. And when that happened, it confirmed a pattern that technicians refer to as a double top that I've traced by this green line, creating this M-like formation. That's an ominous sign suggesting that the market was likely to fall further, which in fact is exactly what it did on Friday. But fortunately, the market stopped at another critical level on Friday when it closed at 2,588, pausing right at the market's 200-day moving average line, this blue line here, which simply tracks the average closing price of the previous 200 days, marking the long-term trend. The fact the market stopped right there suggests that a rebound might follow, which is exactly what happened yesterday. Now, despite all this gyrating, a positive sign is the fact that the two most recent pullbacks that we've experienced, Fridays and March 2nd, ended above the lowest level that we reached in the correction so far, thus increasing the likelihood that we will have seen the worst of the recent correction. Now, we will be watching to see if Friday's close at 2588 manages to hold, or at least that we do not break below this low level of February 9th. As long as that is the case, this recent market behavior would prove to be a healthy consolidation period. Now, there's no guarantees, but we'll be keeping a watchful eye on this and keep you informed. Thanks for your time today. Please reach out to us with any questions.